What's the difference between BRRRR and traditional real estate investing methods? This method stands for buy, rehab, rent, refinance, and repeat. Here's a breakdown of 5 key points to explain the difference between these two methods. 1. Initial investment. Typically, investors might use short-term financing or their own cash to purchase properties under market value, especially those in need of repair. The goal is to minimize initial cash investment, as the property will be refinanced later. Investors either pay cash or use traditional mortgage financing for properties. The initial investment might be higher, especially if the property is turnkey or doesn't require significant renovations. 2. Rehab. A crucial step in the BRRRR method is rehabbing the property. The goal is to add value, ensuring that once the rehab is complete, the property's new appraised value will be considerably higher than the combined cost of purchase and rehab. While renovations can be part of traditional methods, they're not always a core component. Investors might buy properties in good condition and immediately rent them. 3. Renting. After rehab, the property is rented out, generating cash flow. This rental phase is essential as it can influence the refinance terms you'll get. Rental income is also a goal in traditional investing, but there might not be a refinance step afterward. Instead, the focus is often on long-term appreciation and steady rental income. 4. Refinancing. After stabilizing the rental, you refinance it based on its new, higher value. Ideally, you'd pull out most or all of the money you initially invested, essentially owning the asset with little to no money tied up. With traditional methods, refinancing in this manner is not standard. Instead, equity builds over time through mortgage payments and appreciation. 5. Repeat and scalability. The final R stands for repeat. By recovering the capital you initially put in, you're in a position to reinvest it into another property, allowing for rapid portfolio growth. Traditional investing tends to be slower in terms of scalability. As funds are tied up in properties and not recovered quickly, it takes more time to reinvest in new properties. Now let's talk about 3 pros and cons of both of these methods. BRRRR method. Pros 1. Rapid growth. Allows for quick expansion of your real estate portfolio by reinvesting the capital in subsequent properties. 2. Potential for higher ROI. By purchasing properties under market value and rehabbing them, there's potential for a higher return on investment. 3. Capital recovery. Refinancing can allow you to recover most or all of your initial investment, freeing up capital for other opportunities. Cons. 1. Risk in rehab. Costs. Unexpected rehab costs can arise, potentially undermining the strategy's profitability. 2. Refinancing challenges. If the property doesn't appraise at a high enough value, refinancing may not recover the full initial investment. 3. Market sensitivity. The method relies on the ability to accurately assess property values and market trends. Mistakes can be costly. Traditional real estate investing pros. 1. Stable and predictable. Often considered a safer and more predictable approach, especially when investing in turnkey or well-maintained properties. 2. Long-term appreciation. Traditional investing often focuses on long-term property appreciation and steady rental income. 3. Accessible to beginners. Often more accessible to new investors due to its straightforward nature. Cons. 1. Slower portfolio growth. Without the repeat factor, scaling your portfolio may take more time and capital. 2. Potentially lower ROI. Without the value-add approach of rehabbing, returns might be lower compared to a successful BRRRR strategy. 3. Capital tied up. Your capital remains tied up in the property, limiting your ability to pursue other opportunities. Both strategies have their unique characteristics, and the best approach depends on your individual goals, risk tolerance, expertise, and market conditions.